Morning, good afternoon, good evening, wherever you're viewing from. Here in Uganda, it's a good afternoon. Now, this is the third episode of Accounts Fundamental, and in a previous video, we looked at an example of a company's cash transactions and how they are recorded using the double entry method, and we came up with a simple balance sheet, as you can see. However, in real life, most businesses transact on accrual basis, meaning they buy and sell on credit. This gives rise to terms such as accounts receivable, which are amounts owed by the customer to the company. This means that the company sold its goods or services to a client, but the client did not pay with cash immediately but opted to pay in a nearby future. So this is an amount that is owed by the customer to the company. So the company expects to receive money from the customer. And the reverse is accounts payable, which is now the amount owed by us, the company, to the supplier. In this case, now the supplier has given us their products or services, but we haven't paid them for the product or services they've given us, but we have agreed that we shall pay at a later time t in a nearby future. So the big question is, how would our balance sheet look different if the company buys and sells goods on credits? Given an example of, let's say, company bought inventory for 50 on credit rather than using cash, as we saw in the previous example, sold all the inventory for 90 on credit rather than for cash, as we saw in the previous example as well. How would our balance sheet look? How would these transactions be recorded? First of all, buying inventory on credit means that there are no cash transactions happening. So our cash is not affected in any way and it remains the same. However, we are now having a liability, accounts payable of 50, because we are getting inventory worth 50, but we haven't paid anything for it, but we ought to pay. So it's 50 becomes a liability under current liabilities because it's paid within 1 to 2 to 3 months. It's according to the terms of credit that you have with your suppliers. But at the same time, we are receiving inventory in stock. So that's it when you buy on credit. However, when you sell all this inventory for credit, once again, the cash is not affected because you're not receiving any cash. However, our inventory has reduced to 0, from 50 to 0, because we are selling it all off for 90. Our money is held up with our customer who opted to pay at a later date, which gives rise to amounts owed by the customer to us, which is accounts receivable of 90. And this is revenue to the company, because based on the revenue recognition principle, revenue is recognized once a transaction has happened, not only when cash is involved, but as long as a transaction has happened. And in this case, the transaction has happened. So we are supposed to recognize revenue of 90, but remember the revenue costed us 50, and then we paid salary of 20, and then we paid interest of 10, giving us the profits that we recorded in our retained earnings of 10 under the shareholders' equity side. So when we add up the asset side, you can add 40 plus 90 plus 60, we come up with 190. And when we add up our liability and shareholders' equity, we have common stock 100 plus retained earnings of 10 plus 30 bank loan plus 50 accounts payable liability, we still are balancing at 190. And that's how you record a transaction that has to deal with buying and selling on credit. And this is how our balance sheet will look. Thank you so much for watching. If you haven't subscribed to this channel yet, please do so, and turn on the notification bell so you don't miss the next episode on this series of accounts fundamentals. Thank you.